In the last lesson, we looked at how similar groups of securities fall into different asset classes. Now, let's learn how you can apply this knowledge to your portfolio construction by taking a look at asset allocation. What is asset allocation? Simply put, it means you are selecting your investments and organizing your portfolio by asset class. The percentage of investments that you put into each asset class is called the percentage weighting. Just how you go about doing this is based on your investor profile, your investment goal, and your time horizon. For example, a conservative investor who wants to reach their retirement investment goal in less than 5 years may allocate a higher percentage of their portfolio to the fixed income asset class. A moderate investor, on the other hand, who wants to reach their dream vacation investment goal in 10 years may divide their portfolio more evenly among asset classes such as equities, fixed income, and cash equivalents. And an aggressive investor with a retirement goal in 40 years may weigh more heavily on the equities asset class. Ultimately, investors might include all common asset classes in their portfolios, but their weightings would differ from one another. Not putting all our eggs into one basket can help maximize portfolio return and reduce overall risk. Let's look at an example of how this might happen. This graph shows how two different asset classes performed between July 2014 and January 2019. The green line represents equities and the purple line represents fixed income. You can see that equities experienced sharp instances of growth and decline over 5 years, as opposed to fixed income, which saw smoother periods of growth and decline. If an investor had both equities and fixed income asset classes in their portfolio, they may have minimized their risk and maximized their returns during those moments where equities made sharp declines. While asset allocation may allow you to balance risk and return, it cannot protect against something called systematic risk. This is risk associated with the overall market and it's influenced by highly impactful events, such as economic decisions made by the government, like changing interest rates or trade agreements. Another example of an impactful event is a change in the economic cycle, such as going into a recession. These broad factors can be unpredictable and have a far-reaching effect. And because of that, asset allocation cannot entirely safeguard your portfolio from systematic risk. Asset allocation may help with unsystematic risk, however. This type of risk has a more narrow scope. It is associated with a specific industry, segment, or company, and it can be brought on by things like new regulation that's introduced to an industry, a specific company's performance, or a product safety recall. So, how can effectively allocating your investments by asset class help protect against unsystematic risk? Let's look at an example. Angela's portfolio includes a variety of asset classes, and one day she sees a particular stock in her equity asset class drop significantly. If this stock was the only investment in her account, it could have left a long-lasting and negative impact on her investments. And this could take a significant amount of work and time to recover the value. However, since this stock was one of many investments held in Angela's account, the drop had a lower impact on her overall portfolio. Another example of asset allocation is if an investor chooses to invest $100 into one single stock, another $100 into a single bond, and leave $100 in cash with a 33.3% weighting in each asset class. However, there may be a problem with this setup. Within each asset class, there is significant risk. For example, if that one stock drops 50%, then 16% of the overall portfolio loses value. So, how can this be prevented? This leads us to our next section, diversification, which aims to disperse risk even further. Diversification is the act of investing across multiple asset classes and multiple investments within those asset classes to potentially benefit from positive returns and reduce risk. Let's go back to our prior example. Angela's one stock fell 50%. However, if her portfolio was diversified, then her equities asset class wouldn't have had just one stock. It would have had a number of stocks, mutual funds, or ETFs. And those mutual funds or ETFs could have been invested in different types of equities, like small cap, mid cap, or large cap stocks, and also into stocks that are Canadian, US, or internationally based. If she had diversified her portfolio this way, then the impact of major price fluctuations in a single investment could have been greatly reduced. When diversifying your portfolio, consider including a variety of assets that don't always move in the same direction. This behavior of movement between two assets is called correlation, and we touched on it a little in the previous lesson. What's the purpose of correlation? This helps to increase the probability that if part of your portfolio is declining in value, then the other asset classes might be increasing in value. Within each asset class, there are many ways to diversify even further. Let's look at a few common ones. If Angela wants to diversify by sector, then this means she may buy equities from different companies operating within the same sector. For example, within the equity asset class, Angela wants to diversify by investing in a few sectors, such as finance, technology, and oil. Within each sector, like finance, Angela could purchase several finance companies, or she could buy a fund that is focused on that particular sector. Industry diversification. Sectors can be comprised of many industries. For example, technology is a sector, but the industry could be cell phone manufacturers, computer component manufacturers, artificial intelligence companies, and so on. Angela might buy equities from different industries to further diversify her portfolio. Investments in the same industry tend to move in the same direction because they're influenced by similar factors. For example, bank stocks might move in a similar direction if there is a change in interest rates by the Bank of Canada. Geographic diversification. If Angela wants to diversify globally, then her portfolio may include international assets, as well as stocks from other exchanges and regions from around the world. When it comes to the fixed income asset class, investors can diversify by the length of maturity of their bonds. This means they can invest in short-term, medium-term, or long-term bonds. Bond prices fluctuate more greatly the longer a bond has to maturity. While proper portfolio diversification and asset allocation means investing in a number of different investments, it may be costly and time-consuming to purchase individual investments, like stocks. One possible cost-effective way to diversify is by investing in mutual funds and ETFs. These are baskets of securities that are purchased and professionally managed, based on an overall investment objective or goal. If you'd like to learn more about mutual funds and ETFs, or if you'd just like to refresh your knowledge, check out our lesson on common investment types to know in the New to Investing course. Asset allocation and diversification can help your portfolio reduce risk and maximize return, but it can never entirely eliminate the risk of loss. This is why it's important to not only research investments, but to also take the time to align your portfolio with your investor profile, time horizon, and risk tolerance as well. The concepts covered in this lesson provide the foundation of modern portfolio theory. In our next course, we'll show you which tools can help you research your investments and how to begin the process of building a portfolio.